actually, at this moment, we are at a juncture where things are a bit puzzling. Until now, we never spoke about nominal GDP. We always looked at real GDP, but suddenly things are turning. Until now, we always thought lower inflation is good. For the first time, we are cursing inflation for being so low because it's hurting revenues, it's hurting top lines. And for the last 2-3 years, we actually have not worried about fiscal deficit, even though it was at 10% and then 6% and then 4.4. It was kind of bridged pretty easily. We never worried as in the last 2-3 years, that tax collections will not be robust. In fact, we had two or three surprising years when tax collections beat budget estimates. But now it's kind of back to pre-COVID days when we are beginning to worry whether revenues will be enough to cover the deficit. And these two peculiar worries that we have, whether inflation and nominal GDP will be back up again. That is kind of the context in which budget is playing out. And that is also the context in which earnings are playing out. We almost want inflation and nominal GDP back. So with that backdrop, I'm going to shoot the first question precisely on those lines. Sajjid, to you. What is your sense in terms of real and nominal GDP? Are we going to keep that 8% number? And are we going to get back on nominal GDP to double digits above 10%?
Thank you, Latha. It's good to be here. So I think let's just look at real GDP first. And I appreciate that this year could be 7.5%. But this was also a year with multiple cyclical tailwinds, right? You had direct tax cuts, indirect tax cuts, monetary easing, regulatory easing. We sometimes forget a positive terms of trade shock. Oil prices fell by 15%. Strong monsoon and low inflation with boosted purchasing power. Not all of these factors will repeat next year. So I think in thinking about real GDP over the next year or two, the government will probably be conservative and say we go back to about 6.5% or thereabout in terms of real. Now, I think the nominal GDP, there's an overshoot and there's an underlying secular trend. This year was perhaps an overshoot. The GDP deflator this year is 0.5%, which is the lowest in 50 years, right? Because you had 2% CPI inflation and 0% WPI. Those things will begin to mean revert next year. On that lower base, you'll get CPI closer to 4%. But let's not forget the elephant in the room, which is China has got massive excess capacity, something we've discussed for the last 18 months. And there's no sign that domestic demand in China is turning up. And to meet your 5% growth target year after year, you're just producing more and producing more. And the world has to absorb that. So I don't think the Chinese excess capacity is going away anytime soon in 2026. That's going to force disinflationary pressures around the world, but particularly so in Asia. And remember, yes, we've got geopolitical risks, including Iran. But if you look at the fundamental balance in the oil market, this is the pressure will be for oil prices to go down, not up. So I think while you get some mean reversion, we're now in this new world where inflation is going to remain low, and we have to get used to that. So I think prudently, real GDP of 6.5%, a deflator somewhere 2 to 3%. So if you're being very conservative, you'd probably bank nominal GDP at 9%. My sense is the government will probably budget 10% like it did last year. And make one final point. You spoke about how nominal GDP affects tax revenues and earnings. There's another critical component, which is debt dynamics. The government's committed to a debt consolidation path of 50%. The lower nominal GDP you have, if you've got 9% nominal GDP for the next 5 years versus 10%, it means you have to do more primary consolidation of the fiscal to get to your debt target.
Oh, yes, that's the other googly, which I did not refer to. We are used to looking at the budget and looking at the fiscal deficit numbers, but now we have to look at debt to GDP numbers. I don't know whether they will even mention a fiscal deficit and a target in the current budget. They might as well speak just about the debt to GDP. But okay, you think they will have to?
They have to give a borrowing target.
They have to give. But it's very tempting to get to earnings. But since you gave me a question on the platter to someone who has been a long-time metals analyst before he became an equity strategist and an economist, Neelkanth, really that question to you. Will we continue to be bedeviled by a very low WPI because of this Chinese dumping? Two questions, actually. How do you see metals itself? Do you think this copper at $13,000, etc., will peak off? Or do you think, we are, going to be bedeviled by this Chinese disinflation and therefore low WPI?
See, I see the metals in three parts. So there are the precious metals, which are a proxy for wealth, for buying something when you don't trust any currency. When there is competitive debasement happening globally, then you want to get into them. I also kind of agree with the previous panel where on the 3-5 year basis, I think the precious metals are going to do much, much better than they've done. But if everyone around you is screaming buy gold, buy silver, then as a market observer, you kind of start to taper down. So
underperform now, but they still remain long-term
exactly. So, but precious metals, and they do affect CPI for what it's worth, but fundamentally, they're not really a big driver of inflation. Then you come to the base metals, where there is possibility of financial involvement. And I think in some of those, like copper and zinc and lead and so on and so forth, I do think that we can see continued increases because some element of that gold-silver balance, because people will start to bet that if there is going to be competitive debasement of currencies, at some point, these metals, which are hard metals, which will start to rebound. The only risk I see is potentially for aluminium, which I think is priced very high, given that the price of energy is falling. So there can be, financial market interest, but if oil stays at 60, coal prices are lower, power prices are at 1 rupee a kilowatt hour, I think it becomes challenging to sustain aluminium at that level. On ferrous metals, I still think that iron ore at $100 plus is too high. There are specific capacities coming in, and I do think that beyond the immediate restock that we are seeing, there is a bullwhip. So the world destocked in anticipation of a big disruption. Then people figured out, oh my God, the economy has not done that bad, and therefore the inventory rebuilding starts. There is a bullwhip effect. Steel demand is held up globally. But I think ferrous is at a level where it cannot sustain, so it will decline. But on WPI, I still think that food and vegetables are a very major component which have dragged it down. And I think that I think real GDP in FY27 is going to be better than the 6.5 that everyone is expecting, far better. Primarily because the fiscal headwinds reduce and the monetary becomes a tailwind. So now we are seeing credit growth accelerate.
But monetary was a tailwind this year also. Mm-hmm. I mean, we saw the governor's 4 rate cuts coming by June, and then he was flooding with liquidity.
The monetary tailwind becomes effective. So first is that you press the button. Now, when did it really hit the ground? Is when credit growth starts to accelerate. So it is only now where in the last fortnight of December, where suddenly what used to be a 0.8% fortnight over fortnight became 3%. There were some 6.2 trillion rupees of loans that were disbursed. Is that suddenly you find that there is, some of it is, I think, share gains from bond market, because yields went up, so the bond issuance fell. But it's now that credit demand is coming through. And when people borrow, they will spend. And when they spend, that drives the next level. So what was a vicious cycle is now starting to become a virtuous cycle. Now, how long it lasts, time will tell. But I think that the real growth next year is going to be better from this year's perspective. And
this year's is 7.4, but even that looks conservative. You think it'll do better than that?
Yeah, our forecast is 7.5, but 7.4 is also somewhat statistical. Second quarter was on a base of 5.4. But 7.5 next year will feel much better as well. It will feel that people are excited. And the very fact that it seems that companies are also now starting to invest, it will make it a much more all-round kind of growth. So while I agree that I think nominal is what the government will start worrying about, I think a double-digit nominal GDP growth next year is a reasonable assumption.
Okay. So you mean something like a 7.5 plus 3.5 is easy to assume.
So 10.5 is a reasonable.
is a reasonable assumption. Okay, the tragedy of this year, or perhaps the disappointment of FY26 has been so far, we still have 2 more quarters of results to come. The tragedy has been that in spite of this 8% second quarter GDP and 8.2 in the previous quarter, it didn't show up in earnings. Earnings for 6 quarters was low single digits, at least as far as Nifty companies were concerned. Do you see that changing? First for Q3, Q4, and then for FY27?
So look, earnings growth picking up, I think is a kind of a given almost. Even with the normalization of nominal GDP, that itself should get a kicker to earnings growth. So I think that's less of a debate. Issue is, does earnings growth pick up to double digits or to teens? That's the debate.
Yeah, exactly. Is it 10 or 15? What's your guess?
Exactly. So look, markets are pricing in 15. If you look at the headline multiples in a theoretical construct, 10-12% everyone expects. There is a case for it to happen to 15%, as Neelkanth was mentioning, if credit growth picks up. I think that's one of the key things we are watching closely. The credit cycle picking up. The banking system is one of the best capitalized we have seen. There's more capital coming in. And one of the most difficult things to track, and we're seeing early signs of that, is credit standards. What's the risk appetite of the banking system? Like we had Sanjay earlier talking about aspirations to grow. Even the large private banks, which we saw in the last couple of years being fairly conservative, if I can use the term loosening the purse strings, it's happening, early signs. So that's the key variable beyond fiscal, beyond trade, whether credit growth picks up or not. We are seeing early signs of that, for sure.
You're seeing early signs of credit offtake. Okay. Well, actually, to get to mid-teens credit offtake, corporates have to borrow. I mean, retail can take you that far, but the real kicker comes when corporates borrow. Is the capex cycle really looking like taking off?
Not just yet. And I think what we're seeing in India is a rotation of demand drivers. And I think that's important to recognize what's happening, right? So for the first 3-4 years, we actually saw government capex doing a lot of the heavy lifting, and the real estate cycle was very strong. But if you look closely at the data, government capex is now growing, still in double digits at 9-10%, but not at the 20, 30, 40% it was in the previous year. So that impulse has slowed. You look at real estate and a broad variety of indicators, still reasonable growth, but not the rates we were growing 12, 18, 24 months.
No, the last numbers are actually
exactly,
bad. The number that...
You look at cement, you look at steel, you look at housing loans, you look at a variety, top 7 cities and the like. So what you're seeing is the initial drivers of growth post-pandemic have slowed, but new drivers have picked up, and consumption, of course, is the big one. Rural had picked up earlier. You're now seeing autos in particular pick up. For me, the key, Latha, is what is the durability and the breadth of this consumption pickup. Everyone expected this quarter to be strong because it's a double-barreled approach. You've had indirect tax cuts, rate cuts, the 7 factors I mentioned. The question is, 3 quarters from now, will we still be seeing, consumer durables doing well, and will this broaden out beyond autos? If that's the case, then I suspect there's enough demand visibility for corporate capex, which is happening in pockets, to broaden out. I think we're underestimating the fact that there's still a lot of global uncertainty, right? So you've got to marry capacity utilization going up with animal spirits. If every single day you're worried about another tariff and another event shock in the world, and you've got all this Chinese excess capacity, my suspicion is the threshold on utilization rates will have to be higher. So I think we need to be a little bit patient. This is a sugar rush. We're in the midst of it. We need to see if this rotation and growth drivers continues for 3 quarters to then crowd in private investment.
Okay. Well, you're betting that capex cycle is well underway. I thought I read a copy of yours.
Yeah. So whenever someone says, "Oh, capex is not happening," I say, "Show me the data," because everything I see shows that capex is happening.
No, actually, no one really gives us a private cycle, private investment data. We get the CMI data, which is overall. But private sector itself, you feel convinced is...
So you look at the BSE 200.
So you hear data centers, you hear renewables, but we don't have an aggregate number.
Why? Because you look at BSE 200, top 200 companies.
So you're looking at net assets of those companies.
The balance sheet, the cash flow statement that comes, there is an investing cash flow. There is a reasonable breakdown of what is it for M&A and what is it for new investments. you get that data. And that has been growing faster than nominal GDP for quite a while now. September quarter, or September first half, that is the first half of FY26, it grew only 5%, but that was primarily because of telecom. You take telecom out because the 5G capex is done, it's growing at 15% year on year. So there are several such measures. So if you know, in the December quarter, our cement analyst estimates 8 to 9% growth in cement consumption. Now, that does not mean you start buying cement stocks because there is competition happening, EBITDA per ton is not good. But cement is not something that you can build inventory on. Cement cannot be consumed by itself. It will mean that you need to consume steel with it, you need to consume labor with it, sand with it. That means commercial vehicles will move. You look at the movement of commercial vehicles. You know, some of the road operators are telling you that the FASTag usage, the number of times a commercial vehicle taps into these are all up dramatically year on year. So there are many signs that the investment is trying to pick up. And where do you think the last months or last fortnight's credit growth went? I mean, some of it went to NBFCs, but a lot of it went to corporates.